night braving I-85 and sitting in traffic for flights on time last night. But nonetheless, she's very happy to be here. So, you're welcome.
Let's get started. First thing, let me tell you that only half the assignment ones got turned back for some reason. They're all graded, it's just that the other half are not in the boxes, so they should be there later on today. Okay, it's only like one of the graders came back rather than two of the graders came back. So nothing's lost, and we'll get those back. The other thing is, everybody got their midterm back, and I hope everybody got their midterm back. And the average on the midterm was 71. So that's 71 out of 95. So that's actually very high mean for like historically, given my historical sample. So that's a mean that would put this year in like the top 5% of all the times I've done it. And it wasn't an easy exam. So congratulated for it. It was not an easy exam. I don't believe it. So that's great that it exceeded what I expected given my historical prior. That's good. The variance was also fairly high. It was like 12, standard deviation of 12. But it was a very good mean. Okay. And as I said on the exam, I have no problem with you turning the exam back or regrading if you felt something was graded improperly. That's always going to happen. Right, there's going to be some noise. It's a question of like how substantial the noise is. So I'll take a look at the whole exam. You have to turn the whole thing on. The third item of business is assignment number 2. Should be here. If it isn't here, get it to me by the end of the day. Make sure the bottom line is on the front page. It makes it easier because I actually have somebody, actually my secretary will load in the bottom line into the spreadsheet, and then everything will be verified later. So that really helps with the bottom lines there. So get that to me, well, now or at the very latest by the end of today. And assignment number 3, I think it's due on Thursday, but that only allows 32 days in the futures market. So I thought I'd roll that to a Monday. Okay, and if you want to hand in Thursday, fine. Okay, so it doesn't change things if you want to hand it in on Thursday. That's fine. Just like reverse it. But for people that want to let it roll for a couple more days, then we'll hand it in on Monday. Assignment number 4 will be posted this afternoon. Assignment number 4 is a long assignment, but it's different than 2 and 3, which doesn't, well, two or three don't have any analytical questions, whereas assignment 4 does. It can be done within a group if you want. However, I recommend that even if you do it in a group, that you make sure that you understand all the questions and the answers. Okay, because assignment number 4 is, in a way, a forced review for the final exam. And after you write the final exam, you'll realize that it was a good review to the final exam. Assignment 4. Is that what I said? Well, I guess I'll have to revise that too. But it'll be up to date. Okay, so watch for that posting too. It'll say right on the beginning of the assignment.
Is the final cumulative?
Yes. But it's different in that it's true, false, inserts question. Or no, true, false, why. And with the 0 points for a T or an F. Okay, everything's in the why. And there's an example. It's in the packet, right? Last year's final. Yes?
Here you can estimate the amount of time for assignment 4, and found your estimate to be pretty accurate for assignment 1.
Oh, really? Yeah.
Did you use Excel?
Well, I guess that depends if you do it with a group or not. Well, maybe it doesn't.
I intend to use a computer.
Okay. The computer won't help you that much for number 4. So really, 1 was long because if you did it by hand, it was ridiculous. And some people did. So it took a lot of time. But my guess for number 4 is if you did it individually, that you could take up to, well, let's say 7 hours. So that's a lot. Okay. Within a group, it's of course less efficient, right? If you put all the group time together, it could be more than 7 hours, like everybody's time combined. But individually, it's going to be less time. So if everybody puts 5 hours in, 4 people in your group, it's far less efficient. Okay. Any other questions? Okay, let's talk about, let's see, where we left off. With this diagram right here, the minimum variance frontier. And we also talked, I think I just showed you this diagram, the efficient frontier. So the efficient frontier is the blue part, the positively sloping portion. And to start today, what I want to do is I want to talk about how to get this frontier. This is from the previous lecture, optimal portfolio control. So let me, and I think I mentioned a method to do this, but I'll be a little more explicit there. Well, with 2 assets, this was quite an easy problem. And if you did this in Excel, you know, you have a formula for the variance, a formula for the expected return. It's quite easy to get the frontier. But as soon as we have more than 2 assets, this turns out to be extremely complicated problem. For example, we could, you know, just in terms of this diagram, we could, you know, randomly choose weights. And those weights, make sure they sum to 1. The weights will define a portfolio with an expected return that's maybe right here, and a variance that's right here. Then we can mix up the weights again, and maybe we're going to be right here. Mix up the weights again, maybe we're right here. Maybe if we really get lucky, we're on the blue portion with a random set of weights. But there's like millions of different combinations of the weights that deliver portfolios that are basically inside this parabola and on the edge. So, you know, I really can't say that a practical way of portfolio management is the random weight selection method. So what we're going to have to do is to figure out a way to do this in a mathematically elegant fashion. So what we're going to do is to set up our frontier, expected return, standard deviation. And we're going to do something like a linear program. Have you got to that in statistics yet? No? Today? Yeah. Oh, that's great. Oh, that's perfect. Because it's all of a sudden got tangible implications. Something you can do. So, and I think that they'll actually do the application that I'm doing right now. So what we're going to do in Excel is to set something up that's going to maximize expected return, which is EP. Do we know what the formula for that is? Just the sum of the expected returns on the individual securities, so that product of the 2 columns and sum it up. And we're going to have some constraints, subject to, ST, subject to 2 constraints.
What is the notation of
Oh, the sum I equals 1 to n, where n is the number of assets, of the weights times the expected returns of the individual assets. So we have a column of weights, a column of expected returns for different assets. Multiply those columns together and sum. And that gives the portfolio expected return. There's going to be two constraints. First constraint is that the sum of the weights equals 1. Just ensures that all our portfolios have a weight, the sum of the weights equals 1, and that means that all of our money is invested. So there's no currency sitting around that you put in a mattress. Everything's invested. The second constraint, so that's constraint number 1. The second constraint, what it's going to do is it's going to set the variance at a particular level. Let's say it's 0.10. And we're going to search over all the W's, all the combination of W's. We can use Solver in Excel to do this. So this is an equation, or it's a mathematical program that's maximizing expected returns, subject to the constraint that the weight sum to 1 and the variance equals a particular level of variance. Yes?
We're allowing negative weights.
Yes. Weights could be anything. The only constraint is that they have to sum to 1. So if we did this with the brute force method, the brute force method would figure out what every single possible portfolio looks like with a variance of 0.1. Okay, so it would evaluate all these different weights that deliver a variance of 0.1, and we'd have all these portfolios, and basically they'd line up like this. Okay, and what we want to do is to pick off the one with the highest expected return. It'll be known with a red dot. Now, if we use Solver to do this, Solver is going to immediately go to the red dot with some searching. It's not going to need to evaluate the million portfolios with a variance of 0.1. It's going to get there very quickly. Then I'm going to run Solver again, and I'm going to change the constraint. And I'm going to set the variance equal to 0.09, or 0.09. And again, it's going to effectively look at all these combinations and pick the one with the highest expected return. And we can do it again. Equals 0.08. And maybe a small set of possibilities. We could even try 0.07. And it might say not feasible. Can't do it. Okay, well, then we just don't get any dot there. There's no combination of weights that will deliver a 0.07. And if you do this enough, you can kind of see what's going to happen. That we're going to get the efficient frontier. Now, what you're going to do in statistics is known as linear programming. And it's going to look very much like this. You're going to max over something with some constraints. But this is not a linear program. You know why? Something in there that isn't linear. Anything with a square on it that you can think of? Variance. With variance, this thing here is going to cause this to be known as not a linear program, but a quadratic this can be, as I say, within Solver, this is very easy to do. In my second year course, it's kind of like assignment 1 is to set this up. So actually, when you're doing this in statistics, you should be pressing for this application. This is, I think, one of the more tangible applications of the programming problem. Yes?
Is there any particular reason you started off situations at point 1?
Nope. Started off with anything. If I started out at 0.07, it's going to say there's no solution. But I just chose some numbers. So this is this idea of doing it this way originates with the person who was working at IBM in the mid-50s, Harry Markowitz. And this idea was enough for him to get the Nobel Prize about 5 years back. Now, he didn't have Solver in Excel back then. So it was a lot harder for him to work it out. But he basically worked out the quadratic program and showed how you can get an efficient frontier. And had just a huge impact on the way that portfolios were constructed. So this is, as I said, a fairly simple program to set up. It's a couple of lines in Excel. Yes.
What would a negative weight mean in a real situation? Is that just a short?
Yeah. Exactly. So I put negative 10% in whatever stock, it means a short position. Now, I say it's a couple of lines, and you probably wonder what kind of course I've got in the second year. That assignment 1 is like a 2-line Excel assignment. Turns out that it's a little more complicated than the second year. And we worry about things like the ability to short sell. That some securities you can't, and some people just don't want to short sell. Like they'll say, I don't want to short sell anything in my portfolio. So how do we change the setup to handle that? Here, restrict the weights. So we can have a third constraint. And the third constraint says that the weights are always greater than or equal to 0 for all individual investments. And then we also add another thing that says, basically the story is you don't want all your eggs in one basket. So you restrict the maximum long position to, let's say, 40% of your portfolio. So the way to do that, just have a fourth constraint that says we have got to be, less than or equal to 0.40. And we even do things like, because it's a global investment problem, that we can restrict the amount that you put in any particular region. So let's say you don't want more than 60% of your wealth going to Europe. Well, you know what the weights are for the European stocks, and just restrict the sum of the weights. So it might be WI plus WJ plus WK is less than 70%. So it's real easy to add all of these constraints. You can force an investment in a particular, let's say that you want to do this, but you want to force at least 30% of your portfolio in the US. It's easy to do. Put another constraint in for the US, saying the US weight's got to be 0.3 or greater. So this is very general. This is far more general than what Markowitz actually worked out. Because he did it without any constraints. And he was able to mathematically solve this problem and to get the frontier with an equation. But practically speaking, you have to use these constraints. So the math, which is actually in the appendix of the lecture note, is maybe, it's interesting, but not that practical, because in the practice of portfolio management, you've always got these constraints. Okay, now let me do one more thing in terms of this problem, and that is,
If you put in all these constraints, would you still get like the efficient function, or
constraints are binding or not. If they are binding, then you're going to be inside. And if they aren't binding, then you're just going to get the same frontier. So suppose that you solve for the efficient frontier, and it turned out that all of the weights were positive anyway, so there's no shorting. So if you put the constraint no short cell, that has no bite. So it doesn't really impact anything. So it depends. That's the answer. In general, you're correct that it will, if you put constraints on, it's going to reduce your opportunity to set. Yes.
Why don't we exclude risk-free investments, like short-term government bonds?
Why don't we include them?
Yes.
We will. Absolutely. That's really important. Okay, the other way to look at this is, you remember the rules of efficient portfolio selection? So for a given level of variance, you choose the portfolio with the highest possible expected return. And then the other way to look at it was, recollect? For a given expected return, find the minimum variance. So how can we change this program to do that? So what would be max or min?
Mean-variance.
So min, the variance of the portfolio, subject to the sum of the weights equals 1. And number 2, we're going to set the expected return of the portfolio, let's say, equal to 17. So now in terms of the diagram, say this is 0.17. We're going to have a lot of possibilities at 17% expected return. Let me detail some of them. And you're going to pick the one that's got the minimum variance. And the program is going to select the red dot. And then change the constraint 0.15. And again, we've got many possibilities, and we're going to pick the red dot. And we'll do one more. Expected return equals 0.13. And that might be so now we could, with these 3 points, interpolate. So this delivers the same efficient frontier, delivers something else though. Yeah. Notice that it delivers the whole minimum variance frontier. Whereas the other exercise that we did will never put you on the bottom half. Okay, because you're always picking the highest possible expected return for a level of variance. So the efficient portions of these two problems are identical. That's all that really counts. Okay. So this is how to actually implement this idea in practice. With 2 assets, we can do it easily analytically. With more than 2 assets, then I would probably go to software to do this job. So we get out of this a frontier, and now what we have to do is, along this frontier, we have to choose a portfolio. We're going to do that in a number of steps. So let's introduce basically risk aversion to this problem and determine what's going to happen. So we've got the preference directions, higher expected return and lower standard deviation. And these translate into indifference curves. Okay. These indifference curves are positively sloped. And what that means is to get the investor to take on an extra unit of standard deviation, you have to offer extra expected return. All risk-averse investors will have positively sloped indifference curves in expected return in standard deviation space. And this is just an example of this particular investor choosing a portfolio that's optimal. So you would never choose this point, you would never choose this point. That you always want to go as far to the northwest as possible. You want to go into this direction. And the highest possible indifference curve just touches right here, which is called the tangency portfolio. It's one portfolio. And that portfolio is optimal for this particular investment. Notice the ones above the frontier are just not feasible. There's like, you can't invest at this level of expected return and standard deviation. What's feasible is the weight. Okay, so you push these curves out as far as possible and pick the portfolio that is right at the tangency. Okay? This is one particular person. So people are different in terms of their attitudes towards risk. And what we're going to look at is a person that's got low risk tolerance. That means that this person chooses kind of a lower standard deviation portfolio. And a person that's got high risk tolerance, which is a person that is willing to take on extra risk with less compensation. So the indifference curves again are positively sloping, but notice this person has got a steeply sloped indifference curve. So the intuition is to get this person to take on an extra unit of standard deviation, you have to offer a lot of expected return. That's what the slope is, the rise over the run. Okay, so the rise is the increase in the expected return, the run is the standard deviation. So to get this person to take more standard deviation, you have to offer significantly more expected return. As a result of this steep slope, this investor is going to end up fairly close to the minimum variance portfolio. So the portfolio is right here, optimal for this investment. And this is a high risk tolerance investor. And this investor, notice, and this is important, is risk averse. Slope is positive, but notice that it's a lot flatter. So to get this person to take an extra unit of standard deviation, you don't need to offer as much extra expected return. The slope of the indifference curve is flatter, and this person is going to end up more to the right with an optimal portfolio that's got higher standard deviation than the previous investment. So this is how we translate, the efficient frontier to a particular portfolio. Now, how do we get these indifference curves? Well, there's a number of different ways to do it. The first way is not what I would recommend, and that is to try to figure out what your utility function is, and then back out the indifference curves. It's like a few paths. Anybody know what their utility function is? Yeah. Correct. I got log utility in it, but they're in or out there. But I studied these functions. More normal sort of approach to this is to figure out what the degree of risk aversion actually is. So there's a second-year course in decision theory that's recommended if you look at the finance homepage. And part of that is to try to back out what's known as the coefficient of risk aversion. Risk aversion and risk tolerance are inverses, right? So high risk tolerance means low risk aversion. Low risk tolerance means high risk aversion. And there's methods to kind of back out what the risk aversion is. And there's a number of portfolio programs that take that as an input. So input the risk aversion level. So for log utility, the risk aversion coefficient is 1. Very simple. And you put that in as an input into the program, and it delivers one set of portfolio weights for you. The third method, which is the simplest method, is to basically survey the investor, give them different scenarios which represent different volatility portfolios, and ask the investor to choose which scenario the investor prefers. Okay? In this way, the investment manager backs out what the investor's taste for variance is, or taste for standard deviation. And it might be that this particular investor is willing to take a standard deviation of 20%, whereas somebody else would prefer 10%. If that's the case, if we can identify the taste for standard deviation, that makes this program really easy. So search for all the portfolios that have standard deviation of 20%, and then pick the one that's got the highest expected return. Done. Okay, so the third method is probably the preferred method, where you simply determine the investor's taste for variance or standard deviation by survey method. Okay, so this is, this is how it actually works. But there's one more thing that we have to do, and that's to introduce a risk-free security. Risk-free means zero variance, zero standard deviation. And that's going to change the program a bit. Same formulas apply, but now what I'm going to do is I'm going to say, well, given that I've got this efficient frontier, let's see what happens to that efficient frontier when I introduce this zero variance asset. Treasury bill, for example. So let's consider a portfolio, a new portfolio that's got W invested in an efficient portfolio, and that's the expected return on the efficient portfolio, cap E sub little e. And I'm going to have 1 minus W invested in the risk-free at rate RF. There's no expectation on RF because I know what RF is in advance. Everybody see why the variance of RF is 0? If I've got a 1-year horizon for investment, and the risk-free I pick as the 1-year treasury bill, everybody see that the variance is 0 for that investment? It's kind of subtle, because you know the price today when you buy it. You know the price is going to be in 1 year. So the yield to maturity on that bill is simply the return that you're going to get. So the expected return and the actual return are identical. In terms of the formula for variance, it's the actual return minus the expected squared. The actual minus the expected is 0. Therefore, the variance is identically 0.
Now, how is this formula you're presenting different from just putting in and considering just like all the other stocks and bonds we're in, and just have the variance be 0?
Yeah, we could do that too.
Okay.
Now I'll talk about that. But I think it's, let's go through this first, and then I'll come back to just adding it as another asset. So the formula for the expected return on the portfolio is straightforward. So W is the amount in the efficient risky portfolio, and 1 minus W is the amount in the risk-free. The formula for the portfolio standard deviation is real easy. It's just the amount in the risky asset W times the standard deviation of the risky asset. Now remember, our usual formula's got 3 pieces to it. It's got the variance of the risky times the weight squared. It's got the variance of the riskless times the weight squared. Well, that's 0. So that's gone. And then we have that third piece twice, the product of the weights times the correlation times the standard deviation of the risky times the standard deviation of the risk-free. That's 0. So 2 of the pieces disappear. we're left with the weight squared times the variance of the risk. Take the square root, and you get the standard deviation of the portfolio. It's just the weight times the standard deviation of the equity. You know, if we have equities in our efficient frontier. Okay. So it turns out that this really simplifies things. That given this simple formula, where the variance is just the weight times the variance of the risky portfolio, our opportunities turn into a straight line. Okay, so this red line denotes all the portfolio opportunities. This point here is with a weight of 0. A weight of 0 in the efficient portfolio, which is right here, the optimal portfolio, and 100% in the risk-free. This point right here is 100% in the E portfolio. This point in the middle is some combination of investing in the treasury bill and investing in this particular portfolio. And up here, you're actually borrowing to invest in this particular portfolio. Now we can actually see the different possibilities down below. So it's a straight line that can be connected anywhere. And I argue that you always want the highest possible rate. Like, why would you choose, and they're supposed to be different colors, but it's not really that clear. The bottom one is like a green ray. But notice that all of the possibilities along the green ray are dominated by the next one up. So you can always do better in terms of our rules for selection. So for this level of standard deviation, there's a portfolio that's got a higher expected return on the next line up. And you can just continue this until we get a line that just touches the frontier at one particular point. A tangency point. Okay, so this, when we introduce the risk-free, it changes our opportunity set. Before, we had the blue curve, which we call the efficient frontier. And I guess we should really call that the efficient frontier for risky assets. So for assets that have standard deviations. And now we've got a new investment opportunity set. And it's denoted by this line that just touches this frontier and extends beyond. It turns out that this introduction of the risk-free renders a lot of efficient portfolios no longer efficient. For example, suppose we look at the minimum variance portfolio on this blue frontier. Would you ever want to invest in this portfolio? With the risk-free, the answer is no. Because I can get, for the same level of standard deviation, a higher return by being on this red line. And that portfolio is a combination of treasury bills and this particular tangency portfolio. Would I ever want to invest, let's say, right here on the blue efficient frontier? And the answer is no again, because I can always achieve the red line, which has got a higher expected return with the same volatility. So the introduction of the risk-free renders all but one point on the blue frontier inefficient. And that one point is the tangency point. Yes?
Just previous example where you're above the right there. You're borrowing money by doing what? By shorting the stock portfolio?
No, just actually go to the bank, borrow some money, and invest in this particular portfolio. Just levering up.
Obviously, you're assuming the risk-free investment and the higher return than what you borrowed money for.
I'm assuming, what am I assuming about borrowing and lending rates? They're equal, which maybe is not a good assumption. However, if I was doing this with the futures market, is it a good assumption? Because this levering up, what does the levering up mean here? Instead of putting 100% margin down, you're putting 70% down. So it works. This works perfectly in the futures market. Okay? It might not work if we're actually investing in the stocks. To actually go to the bank and ask for a loan to invest in equities might be, you know, you can get it, except you'd have to deposit a lot of collateral like the equities. So this changes the problem, okay? So the kind of the new investment opportunity set is a straight line. So now let's return to the this question: what happens if we go back to our quadratic program and introduce a risk-free asset? Okay, and how does that enter? Well, it's got an expected return, which is known. It's got a variance, which is exactly 0. It's got correlations with all of the other assets. What are those correlations? 0. Something with a variance of 0 has got a correlation of 0. And we could just let the thing chug along in solver. Do the exact same thing where we actually set the level of standard deviation, find the highest expected return. Just keep on letting it go. And what's going to happen? What are we going to get? We're going to get the straight line. It's no longer going to deliver the curve. It's going to deliver exactly the straight line. Okay. And that straight line, and I guess this is interesting now, because the straight line represents levered or unlevered investments in one particular portfolio of risky assets, that agency portfolio. So it's kind of interesting that the person that's got really high risk aversion or low tolerance for risk is going to be, let's say, down here. This person's going to have a lot of money in treasury bills, but some money in this particular portfolio. And the person that's got kind of the opposite preferences, willing to take on extra standard deviations, the indifference curves are going to put that person up here. This person's going to be borrowing to invest in this particular portfolio. So the interesting thing here is that even though your risk aversion could be quite different, you're looking at the same portfolio of risky securities. So the risk-free introduction really changes this analysis. And I think I've got the indifference curves here. So there's the low risk tolerance, and below is the high risk tolerance. It really changes the problem. So it really simplifies the problem. Okay, let me kind of introduce an idea that I can. Let's go back to this one here. If this is really the case, that we've got this frontier, we've got risk-free that people are looking at. And if it's the case that borrowing cancels out with lending in the economy, which kind of makes sense, that the average, on the average, we're at this particular point, the agency portfolio. So people often call that portfolio the market portfolio. And what they mean by that is that if this is the average portfolio, then we can figure out what the weights are of this average portfolio by just looking at invested wealth in the economy. So you look at where people have their money. So if it was a stock market, if 3% of the stock market is taken up by IBM, then this portfolio has got a weight of 0.03 for IBM.
Is this 100% the risky portfolio not being risk-free?
Yeah, that's right. So it says the net borrowing is 0. Borrowing and lending kind of cancel out, which in a closed economy is always going to be the case. In an open economy, it's not the case with trade, but then we could just extend this to make this kind of a world-efficient frontier. It must cancel out. Like if you're borrowing money, you have to borrow from somebody else, right? It doesn't just magically appear. Okay, so the insight here is that this is going to be one particular portfolio, and it actually kind of suggests something about what you should do for your kind of investments. Okay. What it suggests is that if you hold a portfolio and the asset composition of that portfolio mimics the overall asset composition in the economy, that's a portfolio you should hold. And depending upon your taste for standard deviation, you can lever that up or lever it down. But it should be one very simple portfolio that you actually look at. Okay, and I think that there's a lot of intuition to actually doing that. It's not the case that everybody does that, right? Especially if you don't have a lot of money. To get round lots and a lot of stocks is going to cost a fair bit of money. But for larger investors, there's some logic to doing this. So you lever up or lever down one particular portfolio. If this was the S&P 500, this would be real easy to do with the futures. To lever it up or to lever it down. But this is not simply the S&P 500, even though some people like to think of it as that. It includes all assets. You know, bonds, stocks, commodities, real estate. It's the true market portfolio of investment wealth. Okay. So let's develop that more. This is going to be, where this arrow is pointing, is going to be a benchmark that we're going to consider for investment. But first, let's talk about the Sharpe measure. And Sharpe measure is named after William Sharpe. He is the inventor of the capital asset pricing model. 1964, also Nobel laureate. He's got a nice homepage too. Check it out. Okay.
Can I ask you a quick question? Yes. Practically speaking, are fund managers attempting to mimic people's efficient frontiers and get you to invest in a fund based on that?
It depends on the fund. As to what there's a difference often between what they should be doing and what they actually do. Like if you ask a portfolio manager, are you trying to get the maximum possible expected return given your level of volatility? They'll say yes. You know, are they actually running a portfolio optimizer to do that? Often the answer is no. Right? But the basic idea, the intuition behind that is pretty clear that that's what you want to do. As to whether they actually do it is a different question. I don't want to also give you the impression that people don't do this. They do. You know, all of the leading edge asset managers employ some sort of framework like what I'm discussing. Okay, but it just depends where you are. It could be old style portfolio management, which is you look at some fundamentals, invest in the stock with basically random weights. I can, you can beat that with a mathematical program, unless the person's just magical in the ability to select. And there are some people that look magical, really. Just incredible performance. And I'm not saying it's luck, but you have to also consider the possibility that just randomly selecting there's going to be some huge winners and some huge losers. And it's not just fair to look at the actual return, but within the sample of 10,000 managers, there's going to be a tail. It's purely random. So it talks to performance evaluation. We're not there yet. Well, okay, the Sharpe measure. So this is just the formula. What I want to do is to develop a relation between expected excess returns, so in excess of the treasury bill, and standard deviation. I want to link that to the efficient frontier and the introduction of the risk-free asset. And I also want to use it to actually evaluate investment proposals. So this is the formula for the portfolio expected return. It's just 1 minus W in RF and W in E. And the portfolio standard deviation we already did. So I dropped the subscript on the E and the standard deviation. Now, all I'm going to do is to rewrite this in terms of the excess returns. And we've done that before. So it says the expected return of the portfolio is RF plus W times the expected excess return on this particular efficient portfolio. And I'm also going to notice that I can solve for the W here. So the W is just the standard deviation on P divided by standard deviation. Okay, so there it is right below. And I'm going to take that W and substitute into the expected return equation. So basically getting rid of the W in the equation. And what this says is the expected return on the portfolio equals the risk-free plus the standard deviation of the portfolio times this thing here. This thing is known as the Sharpe measure. And it can be calculated for any asset. So all it is the expected return on the asset minus the risk-free divided by the standard deviation of the asset. Sometimes known as the reward to risk ratio. It tells us the reward, which is the expected excess return, divided by the standard deviation, which is the risk. Okay. And we can actually go back to the diagram that we started with, where we introduced the risk-free. What is the slope of this dotted red line? Sharpe measure. The slope is the rise over the run, and if we take this point, let's say right here, the slope is E minus RF, and the run is simply the standard deviation. So this dotted line tells us the Sharpe measure, and this Sharpe measure is a very particular Sharpe measure. It's the Sharpe measure of the tangency portfolio. So remember I said that we looked at various different lines going across? We wanted to pick the one that was just tangent. Another way of phrasing this, maybe more intuitive one, is we want to pick the portfolio that's got the highest possible Sharpe measure. We want to pick the portfolio that's got the highest possible reward to risk ratio. And that's exactly what we've done here. The tangency portfolio has got the maximum Sharpe measure, it's got the maximum expected reward to risk. Now, we can also use this Sharpe measure to evaluate investments, and that's what I'm about to do. So, suppose that we've got two possibilities, A and B. These opportunities are opportunities that are mutually exclusive. Okay, so you can either invest in A or invest in B. If we just look at the data, A's got a standard deviation, and A has got an expected return. Notice on the y-axis, I've got the labels mixed up. And B has got a standard deviation and an expected return. B has got a higher expected return than A, but B has also got a higher standard deviation. So it's not clear which one we should invest in. However, if we introduce some borrowing and lending into this problem, it's a lot clearer what to do. So I've extended A with the dotted line, which means A plus borrowing, and I've extended B with B plus borrowing, and I've also gone the other side to this point right here, which is 100% investment in the risk-free. Okay, you don't do any project, you just invest in the risk-free. Now, which one do you choose? A. Because A dominates B everywhere except one point, and that's 100% in the risk-free, which is kind of trivial. It means you don't choose either A or B. So given a mutually exclusive project selection problem, and we could use this idea of the Sharpe measure to actually determine which investment we want. Now, can you see how to translate this into the Sharpe measure? Sharpe measure is telling us the slope of this line. We want the highest possible slope. We want the maximum expected return in excess of the borrowing rate minus or divided by the standard deviation. So we can actually calculate that, and I put some numbers to this. Risk-free is 8%. Expected return on A is 20%. Expected return on B is 25%. Standard deviation of A is 20%, and standard deviation of B is 30%. Put this all together, and you get a Sharpe ratio for A, which equals 0.6. Sharpe ratio for B equals 0.56. So you select A. Now let's go back up here. Now I've assumed that the lending and borrowing rate is the same. What happens if the borrowing rate is different? How's that going to affect this graph? It's going to be a kink. So it's going to go up with a higher slope. Is that correct? Definition of the slope is going to be the rise over the run, which is the expected return on A minus, in this case, the borrowing rate. Borrowing rate is going to increase, so it's going to decrease the numerator, so it's going to make it flatter. So it's going to flatten things out. So it's actually possible that we cut below B here. So you have to be careful when we actually use the Sharpe ratio, because it might imply a levering up of A that we can't really achieve. And actually, it's not clear to me that it's just a kink, that as we borrow more and more, the lending rate will probably go up more and more. So it's probably more like a piecewise or a curve, depending on how much we borrow. Okay, so let's actually kind of complete this example by kind of proving that this works, okay, with these simple numbers. So let me tell you what I want to do. I want to see what happens if I like B's expected return, and I want to achieve the same expected return as B, but I want to use A and some borrowing. So really, what I want to do is I want to be at this point right here. So I want to solve for the weight to do that, and I want to verify that the standard deviation of this portfolio is less than B. So let's do that. So this is the formula for the expected return for the portfolio. My target is 25% because that's the expected return on B. That's going to be a combination of the expected return on A and the risk-free. So I can easily solve for the W here, and the W turns out to be 1.4167. Okay. So it says 141.67% of your money you're going to invest in A, and you're borrowing 41.67%. Now let's calculate the standard deviation of the portfolio. Simple formula, the weight squared times the variance of A, and take the square root of the whole thing. When you do that, you get 28.33%. So let's go back to the graph. So it's saying that this point here, this is a 30% standard deviation, 25% expected return. So I get 25% expected return. It's the same expected return as B, but the standard deviation is 28.33, which is less than the standard deviation of B. Okay, the standard deviation of B is 30%. So this is how this works, and you could actually change the problem to put in a higher borrowing rate than lending rate and work through the analysis the same way as I did. Okay? The important thing here is this is for two projects that are mutually exclusive. There's no opportunity to invest in both of them. You have to choose one or the other. So one caveat with the Sharpe measure was actually two. There's two caveats. The first one is it's only for mutually exclusive investments. The second one is be careful of your borrowing. Okay.
Say those two again, please.
It's only for mutually exclusive investments, so you can invest in only one or the other. And the borrowing rate might exceed the lending rate, and you have to be careful when you calculate the levered portfolio return, whether it's a feasible return. Yes?
Can I ask a question on this graph here?
Yes.
How does this graph explain the phenomenon that as interest rates fall, people tend to invest in the stock market more? In other words, as the risk-free interest rate falls, people appear to be taking on more risk by going out of those low return investments and going into the stock market. If you move your RF down towards zero, it looks like you're going to be taking on a more conservative portfolio. It seems like what people do is take on a more volatile portfolio.
Well, it's an incredibly complex question that I devote like 3 lectures to in the second year course. And I'll summarize it with a 1 sentence. So your intuition is that the RF, as we move the RF, is going to change the agency movement, right? However, if RF moves, the expected returns on all of the securities that make up that blue frontier could move. And the variances could change. And the correlations could change. So you can't just move RF and hold this frontier constant. That as RF moves, that could be telling us like real fundamental information about the economy. It's going to impact all of the cash flows of the securities. So the problem with your intuition is that you're looking at just changing one thing, holding other things constant, when you can't do that. You have to let other things move too. So it's a really good question, but it's a question that deserves more than a couple of sentences. And that's what when we talk about dynamic portfolio management in the second year course, it's exactly the sort of questions that we address. So what if there's a shock to the interest rates? How does that affect the whole problem? Not just the tangency rate here, but the blue curve and what the component parts of the blue curve are. Okay, well, what is this graph here? This is just a repeat of the graph I did before. It's got the red line, slope of the red line is the Sharpe ratio for the market, which is denoted by M. Sometimes this line is called the capital market line. Sometimes that's CML. Sometimes it's called the investment opportunity set. Sometimes it's called the efficient frontier with a risky asset and a risk-free asset. Everything means the same thing. It means that you invest along this line. But now we're at this point where we've developed this program that will deliver a number of portfolio possibilities. So it says that you can invest anywhere along this line. It will also, if we add in risk aversion or taste for standard deviation, deliver a particular set of weights. And those weights are optimal for us. So the difference between efficient and optimal is that there's many efficient portfolios that are not optimal for me. For me, given my taste for risk, there's one portfolio that's optimal. And we can solve for that. So this really tells us how to set up the portfolio management problem. But what it doesn't tell us yet is what the risk of an individual security is. It tells me the risk of the portfolio. The risk of the portfolio is, for this case, the variance or standard deviation of M. Well, what about individual securities? How can we measure the risk of those securities? Notice immediately we can rule out the variance of the security, because given what we've done already in the portfolio theory, it's not really the variance that counts as much as how this security impacts the variance of this benchmark portfolio M. So when I add this particular security to my portfolio, does it increase the variance of my portfolio or does it decrease the variance of my portfolio? Simple. So what we're going to do when we come back from a break is to figure out, to quantify a way to nail down the risk of an individual security and link that to the expected reward for that individual security. Okay, so let's take a 10-minute break. To fit in with what we've been doing in terms of the portfolio selection problem. So we got my illustration from here. And if you actually plotted your portfolios in assignment number 2, they got to be like somewhere out here, right? And almost for sure they're not efficient, right? We know that they've got very high volatility. Actually, maybe a lot of them are down here. High volatility. If we extend this with the short sales. High volatility and not very efficient. Okay, but that's okay, because we hadn't talked about this stuff before assignment number 2. And this is the direction of preference. So higher mean return and lower variance. Now this portfolio selection idea is a pretty simple idea. And then you're choosing the higher return portfolio and you're minimizing variance. Let's talk about maybe some of the issues that might arise. Like, this is a very simple framework. What are the potential problems? What are the things that are missing? In particular, we might have some preference over some other aspects other than mean and variance. And I'm just wondering what you think those might be. What are we missing here? Yes?
You're missing any expectations of specific stock performance. If you feel that there's, you feel it's much more likely the stock will go up than down, variance doesn't really tell you anything because it says it's an equal chance either way. If it's not an equal chance, then it doesn't fit into this model.
So, one major thing that's missing is the variance is a symmetric type of measure. So if you're 2 standard deviations above or 2 standard deviations below the mean return, it's treated the same way. Do you see that? So expected return is 15. You realize a 45, which is a good outcome. Or you realize a negative 15. Both those deviations from the mean are 0.3. Square it. Well, actually, one's 0.3, one's minus 0.3. But once you square it, you get rid of the sign. So you create, basically the way that we set this up in terms of mean and variance treats all of this symmetrically. It's just not clear that that's what you want. So what you're suggesting is, a lot of people have talked about this, in terms of that you like the good realizations, you like the plus 45, but you don't like the minus 15. So you've got a real preference over kind of like the upside and the downside. What's that called? Statistics? There's mean, there's variance, there's the next one up. Skewness. Okay, well, what that is the mean is just the expectation of x, right? The variance is just the expectation of x minus x bar squared. The skewness was mean, variance, skewness is the expectation of x minus x bar cubed. Real simple. The normal distribution doesn't have any skewness, that the right-hand side looks like the left-hand side. So a normal distribution is perfectly symmetric. A skewed distribution, if it's skewed right, might look more like this. It's got a big right tail, and a skewed left distribution might look like that. I'm not drawing them very well, but so you got right here this chance of a big positive return, and here you got this chance of a big negative return. And it's measured by the cube. So you do your summary statistics in Excel under the statistics thing. It delivers actually 3 things. It delivers mean, variance, skewness, and the 4th is kurtosis. That's, oh, I guess it's not hard to guess what's going on here, right? The 4th. And then measures how fat the tails are. And again, the normal distribution doesn't have any kurtosis. But the skewness could be real important. And the skewness is ignored in what we're doing.
What does kurtosis measure again?
The fatness of the tails. So I'll draw a kurtotic distribution is one. If this is the normal, then the kurtotic distribution might look like this.
In crystal ball, it's something about measuring a peakedness. Is that the same? Measuring peakedness?
Peakedness. Yeah, I think that's, we could say that.
So the fatter tails also mean that you have high standard deviation?
We could draw 2 distributions, and I didn't exactly do it there, with the same standard deviation, the same mean, but different kurtosis. So, okay, what are the other issues? Now, this is an important issue, but there's probably some other things that we're ignoring here. Yes?
It may not be exactly what you're looking for. That's something I've been thinking about. We're evaluating all of the portfolios based on expected return and what investors prefer is higher mean return.
Mean means expected return.
Well, but we're also making a big statement about the link between our ability to assess the expected return and the expected return.
Oh, okay. Okay, I like that idea.
And the eventual return.
Right. Okay, so the first thing is when I say mean return, I mean expected return. I don't mean historical mean, I mean the forward-looking mean. But I think that what you're saying is that one issue that we're kind of ignoring here is the precision to which we can measure the expected returns and the standard deviations.
I really know the return of standard deviation is pretty easy to do this work.
Right. And you might have a definite preference in the two securities. If you've got a lot of confidence in your expected returns for one, and not a lot for another. So yeah, absolutely. That's something that is not in this problem. What else?
You know, if you draw the difference curves, you draw that capital market line, you draw difference curves, I would think that your difference curve would change depending on how long you plan to hold your investment.
Time horizon isn't really addressed. I said, well, suppose it's 1 year. We got the 1 year treasury bill. Well, what if it's 2 years? This is something that we're just choosing on kind of an ad hoc basis. So it's something we definitely want to think about in terms of, making this a little more general.
I think your risk aversion would depend on the magnitude of the investment. If you're investing a couple grand, you might be willing to have a big standard deviation, but if it's 90% of your wealth.
Okay, so risk aversion will be a function of wealth. Like I believe that risk aversion is affected by wealth. So it turns out that actually in a strange way, because if you're very wealthy, then you're willing to take a lot of risk. If you're not that wealthy, then you just can't afford to take the risk, right? Because if it turns out wrong, then you could be homeless or something. But there's also this situation where you don't have a lot of money, and sometimes people will take a flyer, right? A desperate flyer. That desperate flyer doesn't really work well in everything that we've done, but luckily for finance and the theory of finance, that desperate flyer doesn't really impact the market because it's so small. But wealth will affect risk aversion. And I think that our framework handles that fairly well. One thing that it doesn't handle is that if you don't have that much money, then there's no chance of getting that efficient portfolio. Okay, so there could be some capital constraints. In getting a diversified portfolio. What else? Yeah.
You can have personal preferences. You don't like this company or anything in that region, so you just exclude it, such as a lot of stocks from South Africa.
Yeah, or environmentally reckless companies where you just don't want to invest in them. This framework, I think that we can fairly easily modify it for whatever moral responsibility. Yeah, I think that we could probably easily modify it by just putting like zero weights, like forcing zero weights on certain securities. I guess we could do that. But yeah, it's an issue that's not addressed in the theory. Yes?
I think also there are probably some types of risk that don't really show up in the variance. I'm thinking in particular about the example you had earlier where you wanted to force different sectors. That's something that might not show up there. I mean, you talk at some places about basis risk, that doesn't show up there. Also, if you're talking about bonds, I'm not sure that credit risk would necessarily show up in the variance, although it might show up in the expected variance.
Yeah, and what we want is the expected variance. So it should show up there in the expected variance. It wouldn't show up in the expected skewness too. But there are a number of things like, you say basis risk, but things like liquidity probably would be related to what you're saying. So liquidity could be a real factor that we ignore. Liquidity being that maybe we want to sell the stock to rebalance our portfolio, but we can't. The market's so thin, and if we do, we take a huge loss because the price drops so substantially. So liquidity is something that's not really considered. You might want to add to number one, how we measure risk. Measure your risk tolerance. Yeah, that's a good point. And risk tolerance. Anything else? What things might be important that we ignore?
How does it treat investments outside of the general stock and bond markets? There's real estate, venture capital, do that
So,
fit in here well?
Other assets. How do options fit into this? Do they fit into this? They don't. Are the option returns normally distributed? Can they be summarized by mean and variance and correlation? They're skewed. You throw a skewed asset into this problem, it doesn't make any sense. But in general, you want to include these other assets like real estate into this problem.
It doesn't seem like especially conflict are programs, like
Or
with more than one asset. Like, it's easier with two, but I imagine if you're doing a large portfolio, there's going to be covariances that you're not going to.
We want all the covariances. So that's an important part of the inputs. And I'm going to add a fourth thing up here to expected return, standard deviations, and let's say the correlations. We need the expected correlations for all our assets, and we need them to be precise. Anything else that is kind of
So treats all returns the same, but things like taxes.
taxes. Yeah. No taxes in this world. Now, actually, some people don't assume taxes, but it's maybe not that bad of an assumption, given there's a lot of tax-free investors.
Well, what about foreign exchange risk?
So this might fall into the category of other risks. And one could be foreign exchange, something that we haven't considered yet, but international investment, that's a real risk. So let's put other risks. Anything else? I think that's about it. That's about it. Well, maybe I might also, related to liquidity, things like transactions costs. I put a number 9. Okay, so all of these things could complicate this simple analysis. Just as an aside, what happens when we draw this frontier with a preference over skewness? What kind of skewness do you like? Right skewness is, we want that, or left, you don't like that. What happens when you draw a frontier with this extra dimension? Other than it's harder to do. What's it look like?
Goes up that way. Or that way, depending on the students.
So now what we're doing is we, think of the problem. It's actually fairly easy to do, I think. It's like you set the level of skewness and then set the level of variance and maximize the expected return. What's the frontier look like? It's no longer in the simple 2 dimensions, right? It's in 3. Frontier is no longer this curve. It's a surface. It looks like a wave. Right? Depending upon all the inputs, the students. So it's like, it's no longer an efficient frontier, it's an efficient surface. With the risk-free, it's an efficient plane. And what about the indifference curves? What do they look like? Same thing, right? Because you have preference over skewness, variance, and expected returns. So they're like shaped like this, and same intuition, there's going to be a tangency point. So everything works. So you can make this more complicated if you want. It turns out that people are really thinking about how to implement this with students, because the derivative assets have become so important. Right? It's like trillions of dollars of derivatives going on, but nobody knows how to fit it in to the standard portfolio program. But once you allow for this third dimension, you can do it quite easily. So it's an aside, but I think it's an important aside. We talk more about skewness in the second year investment course. Okay, well I want to talk about the capital asset pricing model now. And the handout is at the back. And I'm actually going to show how to derive this model in a very simple way. But before I do that, I want to derive the model in words. And then we'll look at the mathematics to convince ourselves that it makes sense. So the first thing we have to establish is what is a reasonable risk measure for security. The second thing we need to establish is how is the risk rewarded. So it's not enough to identify a risk measure itself. And for it to be a meaningful risk measure, there should be the property that a higher risk leads to a higher expected return. And it's also important for us to know how the risk is translated into expected return. Now you tell me the risk factor is 31,142. Now how can I translate that into expected return? I don't know. I need some way to take that number and translate it into an expected return. Because that's what I'm looking for. I'm looking for a real clean representation. Here's the risk measure, and here is the expected return that I should get given I bear this amount of risk. That's really what I'm after. Now, to be consistent with all of the stuff that we've done in terms of developing the mean variance frontier, showing the efficient frontier, introducing the risk-free, and noting that the tangency portfolio could be considered a benchmark portfolio. It's kind of a logical way to think about risk at the individual security level is the contribution of that security to the variance of a benchmark portfolio. So if I include this particular security in this larger portfolio, how does that inclusion affect the volatility of the big portfolio? We talked about this briefly, I guess last week. Very briefly. So that is a more reasonable measure of risk than, let's say, just the volatility of the security. Because we went through an example last week that showed that you could introduce a security that's got a fair bit of volatility into a portfolio and reduce the volatility of the portfolio. And how can that happen? Correlation could be low or negative. Okay, so just because you've got big variance doesn't mean that when you add that security to the portfolio, that you increase the variance of the portfolio. It could actually decrease. So if it's reasonable to look at a benchmark as kind of like an overall portfolio, then what we can do is to measure the impact of a particular security on the benchmark variance. And it turns out it's very easy to do. That's simply the definition of covariance. So covariance tells us how the variance of the portfolio M changes when I include some amount of, let's say, security I. It's the definition of covariance. So covariance is a reasonable measure of risk. Now, what's different from what I'm saying now and what I said last week is that now I'm talking about the covariance with one particular benchmark portfolio. I'm not talking about the covariance with some inefficient, small portfolio that maybe one of you hold or I hold. Okay? That's not the benchmark that's meaningful. If that was the case, if we measured the risk as the covariance with any individual's portfolio, then each security would have multiple definitions of risk, depending upon the portfolio that we benchmark against. So I want to avoid that. I want to look at one particular benchmark return and measure the covariance of that security with the benchmark. And that's going to give me a measure of risk that people can agree upon insofar as they agree that the benchmark is a reasonable benchmark. So let's pursue that. So suppose that it's the case that this is a reasonable measure of risk. And we've got a situation where security I has got a covariance of, let's say, 0.10. And we've got security J that's got a covariance of 0.10 with the benchmark. So they have identical covariance with the benchmark. Security I has an expected return of 15%. Security J has got an expected return of 20%. What's going to happen? What's going to happen in the market? Two securities with the same level of risk, but with different expected returns. So I's got expected return of 15, J's got expected return of 20. What's going to happen to J? Exactly. So people are going to buy J. What's going to happen to the price of J? What's going to happen to the expected return on J? Yeah. And for I, people are going to be selling I, and the price is going to go down. Expected return is going to go up. Now this is not pure arbitrage, but it's kind of like arbitrage. It's not pure because we could be wrong on our forecast of the expected return and our forecast of the covariance. It's called risk arbitrage. So it doesn't have a zero standard deviation, this strategy of buying one and selling the other. But it is a good bet. So what's going to happen is that these two securities, the price is going to change. It's going to change in a way such as the expected return on I is going to equal the expected return on J. Same risk, same expected return. Okay, so let's remember that intuition, and let's go through the derivation. And let's make sure that the derivation squares exactly with our intuition. Okay, so let's do that. So basically, this is the exercise, and this is I pulled this from an old version of Sharpe's investment book. I thought it was a good presentation of the ideas. So we're going to sit at the optimum portfolio where you've got the weight in M equals 1. And we're going to look at a candidate asset, a new asset to include in that portfolio. It's going to be asset I. And initially, the weight in asset I is 0. The weight in the risk list is also 0. What I'm going to do is I'm going to increase, or I'm going to actually add I to the portfolio. I'm just going to add the amount D. And I'm going to finance it by borrowing. So just basically all this says is I'm going to add a little bit of I to the portfolio. The question is, what happens to the expected return and to the volatility of the portfolio. Now, the volatility, I've already told you what the answer is. Well, actually, I told you something that was not quite that precise, but we'll do it a little more precisely. I said that the covariance was the contribution to the volatility of the portfolio. So, in terms of the mathematics, we want to take the change in the portfolio variance for a change in asset I. And it turns out that when you do that and evaluate it at the optimum, you get this equation here, which says the contribution to the variance for change in asset I is just twice the covariance. So 2 comes out front because there's a square in it. No, actually because it's twice the weight, so that's where that is. So the covariance measures the contribution to the variance and is multiplied by 2. And then we want to measure the contribution to the expected return. The change in the expected return for a change in WI is simply this term here, the excess return on I. So the contribution to the expected portfolio return for a change in I is just the expected excess return on I. Now what I'm going to do is the following. I'm going to write this as a ratio of expected extra excess return divided by the expected extra contribution to variance. The expected extra excess return for I is just the expected excess return on I. Divide by the contribution to the variance, and that's 2 times the covariance between I and M. And you can also do this for asset J. So J's expected excess return divided by the covariance of J and M. And the key to this analysis is the equal sign. Okay. Now this equal sign, this is where it really's got to square with our initial intuition. Remember, the initial intuition said, suppose we've got 2 securities, I and J, both with a covariance of 0.10. And we said that the expected return should be the same. Well, if that's the case, the denominator here would be 0.20. The denominator here would be 0.20. And the expected excess returns must be equal. This works for the special case we talked about. But this is a little more general in that we can have different covariances. And what this relation says is that the expected reward divided by the expected risk has got to be the same ratio for all securities. So it doesn't make any sense that you can invest a little bit more in I and get just a huge increase in expected portfolio return compared to investing in asset J. So it doesn't matter that these are 0.1 and 0.1 or 0.2 and 0.2. It's the ratio that counts. The ratio is the reward to risk. And finally, on the far right-hand side, I did another portfolio. Now, these could be individual assets, I, individual asset J, or it could be portfolio I, portfolio J, or portfolio M. And this last piece is what Sharpe actually put into this analysis. So Sharpe said, well, if I can write this for I or J, I can also write it for M. So you put the expected excess return and divide that by the covariance of M with itself. What is the covariance of M with itself? Variance. Remember the definition. The covariance of M and M just equals times RM minus E of RM. This just equals E of RM minus E RM squared equals the variance of M. And we saw this notation before, that sigma MM equals sigma squared M. So we can write it like this. And, you know, Sharpe's paper is a little more complicated than the following, but basically what we're going to do is to cross multiply. Look at this for I, look at it for M, and cross multiply. Let's actually do that on the overhead. So it says E I minus RF divided by twice the covariance of I and M equals E of M minus RF divided by twice the variance of M. Okay? This term, multiply both sides by it, and we get E of I minus RF equals E of M minus RF times 2 sigma IM, and the whole thing is divided by 2 sigma M squared. The 2's cancel. And what we get is the following. A little more easy to see here. We get a relation between the expected return on I and the covariance of I and M. Notice on the right-hand side, there's only one thing that's driving the expected return. There's only one thing on the right-hand side that's got an I in it. And that's the covariance. So the expected excess return on asset I is not being driven by the variance of I. The variance of I is nowhere to be found on the right-hand side. What's on the right-hand side is the covariance of I and the benchmark M. Now remember I said when we were kind of going through the intuition behind this, that just to identify the risk measure itself is not enough. That we need somehow to translate the risk measure into expected return. And I said, well, suppose that the covariance equals 31,162. That's what I said. We need to translate that somehow into expected return, and this is how we do it. We multiply by the expected excess return on the market and divide by the variance of the market. And does that ratio of expected excess return on the market divided by the variance of the market, is that a little bit familiar? It's like the Sharpe measure in mean and variance space. Remember the Sharpe measure when I drew it in mean and standard deviation? It was the expected excess return divided by the standard deviation. Well, it's the expected excess return divided by the variance. We could always do all of these frontiers in mean and variance. So what is that? What is that line? The capital market line? The thing that hits the efficient frontier at the tangency point? The thing that we were trying to maximize to get the tangency point? It tells us in the market the trade-off of expected excess return and variance. Okay, so given a unit of variance, this is what the market is going to reward it at in terms of the expected excess return. So this formula makes a lot of sense. Because here's the covariance. The covariance tells the contribution to the variance of the portfolio. Multiply that covariance times the way that variance is translated into expected return. And voila, you get the expected excess return of the security. So basically how it works. So we've got the risk measure, which is the covariance. We've got the way the risk is translated into expected excess return by this ratio that very much looks like the Sharpe ratio. Notice this ratio is independent of I. There's no I in it. The only I that we see on the right-hand side is in the covariance. So this is the capital asset pricing model, or the CAPM, as people call it. Very simple model, and the model delivers an expected excess return for any asset as long as you've got the covariance of the asset in the benchmark. Now, sometimes this model is written not in the way that I have pitched it. I've pitched it in terms of covariance being multiplied by the way the variance is translated into expected return. Often it's written like this, where the expected excess return equals the beta times the expected excess return in the market. And the beta, the definition of the beta, is just the ratio of the covariance to the variance of the market. Okay, important. It's the covariance of I and M divided by the variance of M, not the covariance of I and M divided by the variance of I. Now it turns out that the beta is really it's fairly easy to estimate because it's like a regression coefficient. So if we regress the returns on I on the returns on a benchmark, we're going to get a beta. And actually, the regression coefficient, the definition of the regression coefficient is just the covariance of I and M divided by the variance of M. So, we're now in a position to evaluate expected returns on individual securities or portfolios. So, you tell me the beta, or you tell me the covariance, and we've got some knowledge of the way the risk is translated into expected return. Now, we can say something about expected performance. So let's go back to this example of, I guess we did this on last Monday. Or did we? Or was it the very first lecture? I forget. Where we had this advertisement from the Wall Street Journal. You've seen these before, where it shows the fund performance over, who knows how many years. This is 15 years. Franklin Income Fund, 516% return. Dow Jones, 384, and Solomon High Grade Bonds, 273. And actually, the fourth one was inflation. Let's pull that out because it's not really a traded asset. Now, the novice investor would say, well, it looks like Franklin Income Fund can beat the market. But the investor that's maybe taken this course or knows something about portfolio theory would say, well, I need some more information. It's true that Franklin had a better return than the market, but what's the risk? Is it the case that Franklin invests in riskier assets? I need to know that, because just looking at these numbers, potentially I'm comparing apples and oranges. So, first thing, let's translate into average annual returns. And notice the difference, while still impressive, is not as dramatic. Right? This is just a trick of compound interest or returns. So, say it again? No, I did not. No, I took the root to get it. So if you compound the 12.9 for 15 years, you're going to get back to the 15 or 516%. Okay, so I've got annual returns, and now suppose that I tell you what the betas are. So these are the contribution to the variance of a larger portfolio. And there should not be percent signs here, so get rid of those percent signs. Franklin Income Fund has a beta of 1. Now, dividing the covariance by the variance, it's actually very convenient to do that, because what it does is it kind of standardizes the risk measure. So if we've got a beta of 1, it means that the security's got about average contribution to the variance of the portfolio. If the security's got a beta of 2, it means that it contributes roughly double the average variance of the portfolio. And a half is roughly 50%. So it gives us a measure of contribution. Now, you should also note that just because one security's got a beta of 1 and the other security's got a beta of 2, that does not imply necessarily that the security with the beta of 2 has got like double the volatility. Okay, because beta is measured off covariance, not variance. It's covariance divided by the market variance. And I give you the betas here, Franklin being 1, Dow Jones being less than 1, given that this is a portfolio of fairly conservative stocks, and the high-grade bond index, a beta of 0.367. Now we need a little extra information here. We need the expected return on the benchmark portfolio, which is going to be 13%. And the risk-free rate, which is going to be 7. And now we can get projected returns for these 3 investments by using the capital asset pricing model. Multiply 1 times the expected excess return in the market, add in the risk-free, and you get an expected return of 13. For the Dow Jones, you get 11.1. For the high-grade bond index, you get 9.2%. So what does this say? It says that the Dow and the high-grade bond index, the expected return turned out to be identical to what was actually realized. For the Franklin Income Fund, the expected return was higher. The expected return was higher because that portfolio has got higher beta risk. Contributes more to the variance of the portfolio. And actually, what was expected was 13. What they actually realized was 12.9, pretty close. But slightly below expectations. So this really changes the way that we look at that ad. Just a glance at that ad suggests that, wow, these people are beating the market. But a deeper look at the ad, once we know the risk of the different investments, we kind of say, well, Franklin has got a higher risk measured by the beta. It should have a higher expected return. And even if it isn't, even if it's just a small amount higher than the Dow Jones, if I compound that for 15 years, it's going to look pretty impressive. So this model allows us to generate an expected return for a given level of risk. So this is the capital asset pricing model.
Is that also those 2 are an efficient frontier?
No. No single asset is on the efficient frontier, with the exception of 1. What's the one asset?
Risk-free.
It's a risk-free T-bill. Everything else has got to be a combination of portfolios. So no individual security is on the frontier, because nobody would ever hold a portfolio of just one security. Well, people do that, but they're not being rewarded for that variance that they're bearing. The mutual funds, you're going to see a scatter of what they look like compared to the efficient frontier next lecture. And I'll tell you up front that they're inside. And they're inside in a big way. Okay? So they're not even close. Yes?
Was it the market portfolio on the efficient
Yeah.
frontier also?
So the, the overall market portfolio should be on the efficient frontier. That's a reasonable benchmark. That's going to be an issue as to what the reasonable benchmark is for this analysis. Yes?
Just have a question on the use of this. You translated it so that you knew historically what it returned, and then you calculated what you expected to return. And both of those are still higher for Franklin, so would that be a good decision, or how do you use it?
Well, I guess the way I use this is, they're close, okay? 12.9 and 13 are real close. But given the level of risk, Franklin was expected to deliver 13% a year. They delivered slightly less. So I would say that they did not meet my expectations, whereas the investment in Dow Jones did exactly. Well, what I'm looking for is Franklin to deliver 15%. That's what I'm really looking for. I want them to deliver 15, and they should have delivered, given the risk, 13. That's 2% extra a year that maybe I can attribute to their skill in selecting securities. But given the data that I showed you, and let me, if you haven't already guessed, these numbers are constructed rather than being actual numbers. And I don't want to say anything negative about the Franklin Income Fund for fear of being litigated. But given what I know about mutual funds, this would be a very good performer. They'd be very pleased to have expected 13 and they delivered 12.9. That would put them in the 90th percentile of performance. Okay. The other thing is that let's just kind of develop this discussion of what we're looking for, the 15 and the 13. This is the regression equation that's usually estimated. Expected excess returns on I on expected excess returns on the market. Suppose it was the case that Franklin delivered a performance of 15%. And given that we know the residual has a zero mean, and given that we know the beta times the expected excess return on the market is 13%, what is this alpha? 2%. So when you see betas reported, you often see a beta and an alpha reported. And the alpha measures the performance of the security over and above what was expected given the risk. In the example that I gave you with the expected return of 13, the actual return of 12.9, what's the alpha? Minus 0.1. So actually, what we want is a positive large alpha. Okay? Which means we're getting like extra return given the risk. Okay, so adjusting for the risk, we're getting something extra. So people talk about alpha all the time, that their investment strategies can deliver an alpha of 190 basis points, which means 1.9% per year. Okay, or I'm investing with this this fund, and it's delivered an alpha of 5% over the last 5 years. That's what they're talking about. They're talking about this regression where you take out the part that's kind of expected, given the risk, and what's left over is the alpha. Okay, one last thing. Just some words. This part, the beta times the market excess return, this is sometimes called the non-diversifiable or systematic risk. And the idea here is that, if the market plummets and nothing happens at the particular security, look at the firm, the stock is going to be pulled down. Because most stocks have positive correlation with the market. So even though nothing happened at that particular firm, the market drops, the firm's stock is also going to come down, usually. So there's a part of the return that's kind of driven by what happens in the market. There's also another part of the firm where the epsilon is, which is called the diversifiable, non-systematic, or idiosyncratic risk. this is something that's specific to the firm. Like there's a crash of like a jet that happened to have all the executives on it. Okay? And that could drive the stock price down, it could drive the stock price up, depending upon the market's perception of their skill in managing the firm. Now the point is that in a portfolio, that bad news is going to be offset by good news in another firm. And that's the idea of diversification. So this part of the risk is not rewarded. This part is. And the last insight to notice, if we put this risk together with this risk, what do we get? Get the variance. The variance of I. So if we put the systematic together with the idiosyncratic, we get the variance of I. The variance is not rewarded. It's the systematic part of the variance that's rewarded. So what we need to do is to decompose the variance into these two parts. One part is systematic. That's got reward. That's the beta risk. The other part of the variance is diversifiable. It's non-systematic. It's not going to be rewarded. So if you hold a portfolio of one security, it's got a variance. You're not going to be rewarded for that variance. What you're going to be rewarded for is only part of that variance. And the part is this systematic part. Okay, so Thursday we'll continue this and do performance evaluation also.